The name Tesla reverberates throughout the automotive sector. It is a name that embodies creativity, power, and electricity. The street was looking for information regarding price reductions, the end of the gross margin outlook, and a final peek at 2024. Rather, it was more of a must wear his macroeconomist hat, and the public didn't care for it. In the end, I believe there were too few details, and it was a depressing note, especially in light of the Cybertruck and the revised margin expectation. The long term thesis, in my opinion, remains, but without rose colored spectacles. This was, in fact, everything I would consider a disaster. So, let's take a journey around Tesla Incorporated's universe today. A voyage full of discoveries, epiphanies, and unsolved mysteries. This film examines how Tesla is more than simply an automobile manufacturer, from the mysterious Cybertruck ready to upend the industry to the supercharger network that sparks a wave of revolution and Elon Musk's inspiring leadership. Fast forward to when we break down current developments, decipher Tesla's tactics, and reveal its formula for success. Tesla is not your typical competitor in the fiercely competitive market of electric vehicles. This force to be reckoned with is set to make its next move known. Please click the like button and subscribe to Tesla Stock News before continuing. Let's get going now. The optimistic prognosis for Tesla Incorporated did not produce the anticipated outcomes as it did in the most recent quarter, with the company trailing the overall market in some of our earlier evaluations. The management voiced concerns about the difficult circumstances that are now in place, and the most recent earnings report was disappointing because it did not meet consensus projections. Still, these challenges are seen as transitory rather than a sign of a longer-term pattern. The company's production volumes are in line with its set goals, and revenue is still growing. The decline in profit margins is principally attributable to the discounts offered on Tesla automobiles, a tactic intended to cater to a more cost-conscious customer base rather than being a sign of a long-term pattern. In spite of a drop in profitability measures, Tesla continues to outperform its rivals in terms of financial efficiency because to a solid balance sheet that offers a stable base. This puts the business in a good position to handle the difficulties it is currently facing without sacrificing its dedication to growth and innovation projects. A thorough valuation study confirms the opinion that the stock is substantially cheap, and as a result, tsla is still strongly recommended as a buy. It is recommended that viewers take this viewpoint into account while evaluating their financial choices. Following the announcement of its earnings report on October 17th, Tesla Incorporated saw a major reaction from the market in the most recent quarter. Investors became concerned when the company failed to meet consensus estimates, posing difficulties. In spite of this setback, a few significant features merit further investigation. Above all, it is imperative to draw attention to the company's outstanding sales growth, which climbed by a staggering 9% annually. Given the current high interest rates for auto loans and leases, which have been a barrier for many participants in the automotive industry, this development is especially noteworthy. Although the increase in sales is praiseworthy, it is important to recognize that profitability measures have significantly shrunk. Both the operating and gross margins for Tesla fell significantly by almost 7 percentage points and 17.2% and 7.55%, respectively. Despite the fact that these numbers could worry investors, it's critical to consider all sides of the issue. Tesla's capacity to produce $647 million in positive leverage-free cash flow, FCF, is one encouraging development. This accomplishment has made it possible for the business to keep bolstering its already strong balance sheet. Due to its excellent liquidity and low leverage, Tesla is well positioned to overcome the obstacles facing the market right now. Even when compared to automotive behemoths like Toyota Motor Corporation and Volkswagen AG, Tesla continues to beat its industry peers in terms of profitability on a trailing 12-month basis, despite the fall in profitability indicators, which together sell between 10 and 8 million automobiles a year. Across major profitability indicators, Tesla remains competitive, indicating that its operations are intrinsically more efficient. This advantageous position is encouraging for Tesla's long-term prospects of gaining a greater portion of the automobile industry. It is important to comprehend that the principal cause of the decrease in income was the significant markdowns imposed on a range of models, especially the more expensive items like the Model S and Model X. Given that Tesla continues to be the most profitable company in the business, it seems wise to prioritize the delivery of a sizable number of vehicles in the context of the ongoing and fiercely contested electric vehicle race. This approach is in line with the early phases of the EV market's growth, when gaining market share through volume may turn out to be a crucial long-term benefit. The current performance of Tesla paints a complex picture with possibilities and problems. The company's growth trajectory and operational efficiency remain noteworthy, notwithstanding a decline in profitability measures. In the highly competitive EV industry, choosing volume over short-term profitability is a wise move that fits with the company's long-term strategic objectives. When making investment selections, investors ought to consider these elements as they evaluate Tesla's standing. When evaluating Tesla Incorporated's present course of action, it is clear that the company's decision to put increasing car deliveries ahead of short-term profitability is well suited to the particularities of the electric vehicle market. Modern electric automobiles are sophisticated computers on four wheels, not merely means of transportation. Most importantly, these cars' intelligence can be easily updated through over-the-air software updates. This feature allows for the possibility of a land and expand business model, similar to the strategy used by software businesses with great success, which has great long-term potential in the car industry. Tesla's yearly software development R&D expenditures, which total billions of dollars, demonstrate the company's dedication to this innovative strategy. With its emphasis on software, Tesla is positioned to perhaps change the automobile landscape several times in the years to come. Elon Musk highlighted Tesla's outstanding advancements in fully autonomous driving technology during the company's most recent earnings call. Tesla is the only company in the automobile business using real-world artificial intelligence, AI, with an enormous database of over 500 million miles of real-world experience and an exponential development trajectory. The land and expand technique, which is frequently associated with the success stories of the software sector, entails creating a solid foundation in a market, then capitalizing on it to achieve more expansion. For Tesla, this means providing attractive cars with state-of-the-art software features in order to gradually take market share in the EV segment. Tesla wants to establish its supremacy and completely transform the automotive industry. Therefore, it is concentrating on vehicle deliveries and making significant investments in software R&D. A number of occasions, Tesla is positioned as a pioneer in the ongoing evolution of the automobile into a complex, connected, and intelligent device thanks to the synergy between its hardware and software. The unique nature of the electric vehicle EV sector, where software plays a critical role in determining the future, is reflected in Tesla's strategy emphasis on vehicle expansion over immediate profitability. The company's successes in autonomous driving technology and its dedication to research and development highlight its unparalleled standing in the field of real-world artificial intelligence in the automobile industry. This calculated move positioned Tesla for long-term success in the rapidly changing electric car market and is consistent with a land and expand business strategy similar to that of successful software businesses. These elements should be taken into account by industry watchers and investors when assessing Tesla's long-term prospects and competitive advantage in the auto business. The significant operational expenses linked to the creation and manufacturing of the much-anticipated Cybertruck were a notable cause of the recent decline in profitability. It's critical to recognize that there has been some skepticism about this product, mostly due to a string of release delays that have made many onlookers wary. The recent reports suggesting that only 10 units will be delivered during the next event have added to the negativity surrounding the Cybertruck. But it's important to think about an important tipping point coming up, the November 30th delivery event. This indicates that Tesla is prepared to join the fiercely competitive U.S. light truck sector, which sells about 11 million vehicles a year. For many years, the Ford F-150 and Chevrolet Silverado have been the industry leaders in this market. In order to establish a durable presence in this very competitive market, Tesla needs to launch a remarkable product. My faith in Tesla's ability to pull this off is strengthened by the company's proven ability to disrupt the automobile sector and its strong history of innovation. Rather than seeing the manufacturing delays of the Cybertruck as a bad thing, I see them as an indication of Tesla's steadfast dedication to provide the product with features that no other product can match. I think these characteristics will be shown at the next event, which could change the way the light truck industry is shaped. Profitability may have been harmed by the high running costs of Cybertruck's development, but it's crucial to acknowledge the importance of the impending delivery event. The company's commitment to producing a genuinely remarkable vehicle is demonstrated by the product's release delays, which mark a turning point in Tesla's entry into the U.S. light truck market. Given Tesla's track record of innovation and disruptive power, the event could introduce a game-changing product that could pose a threat to the industry's top competitors. When evaluating the possible effects of the Cybertruck on Tesla's prospects and competitiveness in the light truck market, several factors should be taken into account. In addition, I believe that Tesla's supercharger network is a strong asset with enormous long-term potential. It highlights how strong Tesla's energy infrastructure is as more and more major automakers, including Ford, Mercedes-Benz, GM, Hyundai, and Volvo, adopt its charging standards. This endorsement from major established automakers not only highlights how strong Tesla's charging network is, but it also gives the company a significant competitive edge in a worldwide EV market that is expected to continue expanding rapidly. The clientele of the supercharger network is anticipated to increase quickly, and this growth trajectory will likely open up a new and consistent revenue stream that is immune to changes in macroeconomic circumstances. Not to be overlooked is Tesla's ability to reconcile upending the auto sector with upholding strict financial discipline. Zachary Kirkhorn, the company's CFO, stressed on the Q3 earnings call that cutting costs is a primary goal for the management team. The significant and persistent decrease in the cost of goods sold per car provides concrete proof of the CFO's steadfast dedication to this goal. Given the anticipated long-term growth of the company, it is quite probable that Tesla will continue to reap the benefits of the economies of scale impact. This continuous cost effectiveness is going to produce increased value for investors. Regarding the stock's value, it's important to remember that Tesla has beaten the U.S. market as a whole in 2023, achieving an astounding 117% year-to-date increase. Expert evaluations have given tsla the lowest possible valuation grade of F. This is mostly because the company's valuation ratios routinely above the sector median on a number of different metrics. Nonetheless, it is wise to take into account Tesla's unparalleled growth trajectory, profitability profile, and unique brand positioning when assessing the company's present value ratios. The stock looks to be very attractively valued from this angle. The distinctive characteristics that characterize Tesla's business model should be taken into account rather than just comparing the present valuation ratios to historical averages. Given its innovative past, growing supercharger network, and cost-cutting initiatives, Tesla's valuation is commensurate with its ability to completely transform the car industry. As such, evaluating Tesla's price in the context of its distinctive qualities might offer investors a more enlightening viewpoint. We've dived into a thorough analysis of Tesla incorporated thus far, looking at many facets of the company's performance, strategy, and outlook. We'd have to end this video for the time being. We have looked at how recent events have affected Tesla's earnings, how important it is that the company prioritizes innovation and software, and how the Cybertruck might change the game. We've also talked about Tesla's dedication to striking a balance between financial discipline and disruption, as well as the strategic significance of the supercharger network. Now, given the rapid advancement of the electric vehicle sector, what do you think of Tesla's policy of putting vehicle growth ahead of immediate profitability? And given its distinct growth trajectory, profitability profile, and brand positioning, what do you think about Tesla's valuation? Please feel free to add your ideas and observations in the space provided below. For more in-depth information on TechIt,